comparison of a predicted moving average and an actual moving average. The blue line is a medium-term moving average comparison. The green line is a long-term moving average comparison. It acts as a momentum type of an indicator because it suggests what the underlying market is doing and whether the market, even though prices may be going up, what's the underlying feeling about the market as reflected in the predicted differences. So that's one way that I use the predicted differences. You can see that in the cases of the predicted differences here where we have a situation where the angle is down, that's negative, or for prices, indicates prices are going down. You have the relationship to this zero line here. Is it below the zero line or above? If it's above, that's indicating a market that's picking up a little steam. Below, it's losing some steam. So you have a couple of situations here where the market clearly in the recent days has been losing some steam. A key indicator that you have with the predicted differences that I find is where the medium term crosses the longer term. When that blue line crosses, it means that something has happened to help pick up the markets and give them a little boost, and so that's typically a sign of some short-term strength. Now, these indicators are not used in isolation. They're all used together, so don't get the idea that, one of these is the holy grail and the secret to success and all that, because it's not going to work that way because, you just can't find that holy grail type of a situation. Now, before when I was talking, I said keep an eye on this particular candle here at the top. If you will look at that candle, that crossover occurred on January 20th. There's also a situation here, depending on how you approach this particular thing, that let's say you see a crossover like this, and your strategy is to enter the market on the open the next day. So at that crossover, that meant that if you did open on the next day, this was on January 21st, you would have opened or got in on the open short at 1134. Now, as I mentioned before, if you were looking at remember the purple indicator that I showed you, the purple moving average, which was a standard traditional moving average, and it did not cross over until you got to this candle right here before you had a crossover, and that meant that if you'd have got in right here at the open on this particular day on January 22nd, you would have gotten in at 1110 on January 22nd. The difference between 1134, 1110, you don't need a calculator to figure that one out. 24 points, $1,200. A pretty good clue or pretty good idea if you would like to trade, that you like to get the most out of your trading and so forth, and that is to take advantage of those crossovers as early as you possibly can. Now, this is only using the moving average crossover techniques, and as I mentioned, keeping in mind that you are also watching the predicted differences, where are they, and you're also watching what is going on here in this particular case with the Neuro Index, which was dropping to zero. All suggested that this was a period of weakness, that the market was ready to head lower. Doesn't guarantee it's going to head lower, but the probabilities are that it will. We're going to now look at the Vantage Point has, we're not out of indicators yet for Vantage Point. There are some other things that we want to look at on Vantage Point and what advantages it can provide to you in terms of signals, and if you can get in earlier, the better, and with more sound signals, so much the better. I've showed you on here, I'm going to just add another indicator, which is kind of an interesting one that I like and particularly like to use, and that is the predicted high and the predicted low for the next day. I'm going to leave on here, it's a little bit, maybe little clutters up the screen just a little bit, but if you have it on full mode, maybe you can figure it out or track it pretty carefully. I'm going to cut down our time on this because if we get too much data on there, it looks a little confusing, hard to read. So we know what the trend is. We know kind of what the pattern has been. We kind of know where we're predicted high is that gold line or that orange line that you see on top. The predicted low is that pink line or fuchsia, some people call it, that suggests what the predicted low for the next day will be. That's the pink line, and that gives you the range of what is expected for that particular type of a trading day. Now, you have a couple of situations here where we're going to take a look at, that you will have a, sometimes a penetration, you get faked out, you get these jabs, you get things that happen in the market, and you don't necessarily want to get caught in something. So typically what I like to do is I like to leave a little bit of a leeway. And in the case of the E-mini, again, I want to keep my risk parameters in mind. I want to not risk more than about 10 points is about the max I want to do, because 10 points times $50 a point, $500. I'm using E-mini contracts here. You can, if you don't trade E-minis, just kind of factor it into what you trade. But I'm using E-mini to cover as many people as possible, because I think that a lot of people are more interested probably in keeping risk under control and using the smaller size contracts, which are traded electronically and have very good liquidity and a lot of various price move, volatility, a lot of things going in their favor. Now, in looking at what we were looking at the charts here, I mentioned there are a couple of places in here where if you were to trade and we're looking at this, you might say, okay, I'm looking at this point right here, and I'm looking at this point right here. Would that have gotten us in? Well, my 10-point criteria there would not quite have gotten us in. In fact, it might have missed by only, half a point or so, but it's, in any case, would not have gotten you short until you come over to this particular candle right here. This candle has, as you can see, the shadow that goes down there, the place where the market did trade during the day. This happened to be on January 20th. The predicted low that we had right here with this little pink line here, that predicted low is at 1139. So that means if you're selling and you're giving it that 10-point leeway, you're going to be in at around 1129 or thereabouts. And it just barely got into that area that day, but it would have had you short. Now, the market would have gone against you a little bit. So one of the things that you do want to do always is keep that risk factor in mind. Where would you place a stop? What would happen if the market turned on you and you did not have it going your way immediately? If this particular case right here, we did have a situation where the market was topping. So if I were placing a stop in this type of a situation, I would probably keep a stop right above the entry candle high, and that would have been somewhere right in here. It would have been about 1147. That's kind of on the outside of the highest risk that I'd want to take if I were in it at 1129, 1147. But that's one of the things when you initially start a trade, get into position. There are some additional risk that you do have to take sometimes to be able